Greetings, everybody. I've got one of my favourite guests on and one of your favourite guests on. And he's going to talk, as he always does, Nick Ward, about gold and the implications of gold. And I always say the same thing here. I'm the great strategist. I'm a strategic thinker on these matters. But the beauty of Nick's expertise is he's on the coal face. He's absolutely on the front end of it. So he knows what's going on a day-to-day basis. So you might argue he's the tactician, as it were, whereas I'm the strategist. So he's going to give us the benefit of the experience of what he's doing at the moment, what's happening in the markets at the moment. So it's almost sort of straight from the stable cat, as it were. I'm going to leave it all to you, Nick, as always. Bring us up to speed. Been a funny old first. We're just turning the first half of the year. Been a bit of funny old first half. Tell us about that and tell you where you think everything's going.
Yeah, it's certainly been a funny time, Godfrey, for sure. We can all see what's happened to the price of gold. It hit a high of 4,150 odd pounds in January, and then it's crashed nearly 25%. And rightly so. Some people are quite angry. They're quite frustrated at this dip. I hear it every day from people at the moment. And this isn't helped as well, I don't think, by the fact that there is so much clickbait out there in the headlines, screaming that the gold trade is over. It's in free fall. It was overcooked. But this is not a breakdown in the gold market at all. It's a setup. And when you see these patterns developing in the market, we'll just look at 50 years of history. You can't unsee them again, but they happen after every major crisis in the metals market. And the last time that both gold and silver were kind of sat where they're sitting at the moment, right now, silver went up over 300% and gold went up over 240%. So, yeah, you're right. With the Iran conflict, it breaks out and the price dips. Gold did the exact opposite from what most people thought it would do, of course. But as a holder of precious metals, once you understand what's happening, I don't think you'll look at another crisis in quite the same way again. I think it'll actually excite you. So excuse the pun, Godfrey, but there is a silver lining to this cloud that we're in at the moment. But the long and short of it is, look, at the start of a crisis, you inevitably see a geopolitical shock. War, embargoes, whatever it is. Oil then goes up. And when oil spikes, inflation doesn't go up immediately, but expectations of inflation do. The Federal Reserve, they can no longer cut interest rates. As they see these expectations are on the rise. And when the market realizes the Fed won't cut, interest rates go up. And this is what they call bond yields. And look, these are interest rates that the market set, not the government or the Fed. This is the market. And it's what the market actually expects inflation to be, rather than just the Federal Reserve's short-term target. And I think that's a real common misconception amongst the public, is that the Fed, the Bank of England, set the rates. They actually don't. It's the market that does that. They don't want you to know, of course, but that's how it works. That's the brutal reality. And I don't want to lose people here. This sounds a lot more complicated than it actually is, but it's not. So please just do stay with me. But to understand bonds, I mean, this is the industry you were in, Godfrey, for so long. But all it means is how much interest you get from holding a country's debt, from holding US debt, UK debt. So if you're getting 5% by holding American debt, and that's all it is, it's just an IOU, it's just a paper promissory note, and gold is sat there doing nothing, what do you think all the big money does? So your pension funds and your institutions, well, it goes into what they see as a sure bet, the guaranteed thing, the guaranteed rate of return, because there's an opportunity cost to holding gold. There's no return on it at all. So what happens then when everybody starts going into this American debt? Well, the dollar strengthens, of course. Every pension fund moves their money into the one safe haven that they all believe in for some very odd and strange reason. I can't figure out why, Godfrey. But money pours into US debt, and then every country in the world, they've got to sell their pounds, their euros, their yen, their renminbi, whatever it is, to buy dollars. Now, as gold is priced in dollars, a stronger dollar means gold is more expensive for all the international buyers, which of course reduces that global demand. So at the moment, over the last few months, gold has been hit by these headwinds. You've got high bond yields, higher interest rates, and a strong dollar. And then on top of that, we've had a lot of forced selling as well from institutions who need to raise the cash. They're getting margin called. A lot of them have even been locking in their profits over the last year because of course, the rally that we've already seen. But gold is just doing what it should be doing, which is acting as a guaranteed source of liquidity for these institutions. So these are the reasons the price has fallen so dramatically over the last few months. So hopefully people can understand now, look, the world's burning around them. Everything's going to hell in a handcart. Why is my gold falling? Well, that's the reason. That's the reason it's fallen in the short term. But these dips, Godfrey, they happen every single time. And if we just go back very briefly over the last 50 years and we look at every energy crisis and every embargo, it does exactly the same thing. You'll remember, Godfrey, in 1973 with the OPEC embargo. Gold initially dropped and then it rallied 70% within months. Go forward a little bit further to the Iranian Revolution in 79. Oil spikes, gold did nothing, then it went up, 280%. Silver actually went up 400%. Again, coming further along, in 1991 with the Gulf War, Iraq invaded Kuwait, the gold price increased 13%. 2008, the gold price dropped 30% following kind of deflation, following an initial liquidation in stocks, and then it rallied over 160%. And more recently, we've seen the same with Russia and Ukraine as well. Gold broke $2,000. So gold initially tends to drop and then it recovers to higher highs every single time. And I think that's what's really interesting for people to understand and to ensure them that, look, don't worry, there is hope. The gold price is going to carry on going up. This is just a very, very short-term pullback and you should see it as an opportunity. Look, so many. Go on, sorry, Godfrey.
It's not just a graphic view for me. It's not just a graphic. You see, I'm an old geezer now. I lived through all this. I lived through it in real time. So I'm now nearer 80 than I am 70, and I was in the city at the time that all this happened. And I think just to give everybody listening the heads up on this, and I was one. I was a fund manager for pension funds in the city with some modest success. But what you've got to bear in mind, if you are a fund manager, and I was with one of the biggest in the world, Mercury Asset Management, as it was in those days, the fascinating thing is, in order to keep your job, you just need to stay ahead of the herd. The herd behaves in its way. So if the market drops 20%, I'm talking about an overall portfolio, and yours only drops 19%, that makes you cock of the walk. So the proud boast, and we used to laugh about it when I was a young man in the early 1980s in the city, our proud boast was, we lose you less money than anybody else. which is a little bit embarrassing. But the long and short of it is, of course, with pension funds, which is why I think I was reasonably successful, pension fund management, because that is by definition the long-term view. It's by definition the long-term view. And of course, people at the moment, if they're running shorter portfolios, That's point one. So they don't really understand the concept of strategic base holding. And of course, the other thing is with gold, it's an unregulated in specie. It's an unregulated market. So it's very difficult to charge fees. It's much easier to charge fees on a bond portfolio than it is on a gold portfolio, which is sitting in a vault. So
Hmm.
you've got a lot of self-interest going on here. So people don't be, and I have been in the game a long time. Don't worry if you bought near a high. I've been accumulating for years and years and years. I've dropped the occasional bollock, make no mistake. Oh yeah. Nobody gets it right all the time. And there was one stage I bought at 17, I think 1700 uh, uh, dollars an ounce of gold, and it dropped something like 10%, and it stayed down for over a year. Now the thing is, it's easy for me to say that because I sleep tight at night. It's no problem for me because I do this for a living, or have done all this for a living, so I know how it behaves. But if you're a newcomer to precious metals, you're going, "Oh my God, I've dropped, I've dropped a bollock here. I've made a mistake." Well, you haven't. You've just got to sit it out. And don't forget, the city and Wall Street, everybody else are by definition short-term bandwagon people. In order to make sure that they're not as bad as everybody else and they're not looking ahead, some of these. Sorry to drone on about this, but when I go to the city sometimes, now I'm looking at chaps who are fund managers who are still in their 20s. They're only out of university for a few years, good universities, and they're nice guys and they're articulate. They have never seen a bear market in anything.
No, not at all. You're absolutely right, Godfrey. And I think a lot of retail investors get surprised by this kind of a move. And they always chase too late and buy at the top and then they sell at the bottom. They panic sell. It's human nature and it happens every single cycle. But you're right, there's a huge difference in strategy between retail and Wall Street. Um, and again, I don't want to get too technical, but there's a technical level that every single institution and fund watches, which is something called the 200-day moving average. Sounds very boring, just in case no one knows what it is. This is the most closely watched long term indicator in finance. So it just represents the average closing price of an asset over the past 200 trading days, which roughly corresponds to 1 year of trading. That's all it is. The price has fallen so much now that we're now trading below it, which is something that happens actually quite rarely in the market. And when gold and silver sit below that line, which is where we are right now, we always get the best chances of strong rallies after it. And if you look over the last 10 times I think that gold touched the 200-day moving average, over the next 12 months, the average increase was about 8 to 9%. And I think that's based on about a 60% likelihood as well. It's a 60% chance that's going to happen, which in betting terms is a good number. So see it as an opportunity. That's in normal times. The conditions at the moment are far more extreme than any of the previous occasions that this has happened. So look at 1973. US debt, Godfrey, was about 500 billion. Now it's at 40 trillion. They're paying 3 billion a day in interest. And if you look at it over the year, that is more than America's entire military defense spending. That to me is absolutely insane. So this cannot carry on indefinitely. Of course it can't. Back then as well in the 70s, central banks were also selling gold as opposed to buying it, which they are now. And again, Godfrey, you can't blame retail investors for what they're doing here. They're locking in their losses. They are panic selling. There's so much media coverage out there convincing them that this trade is over. But follow what the smart money is actually doing. Follow what the investment bankers and the big institutions are doing. They call it alligator investing. So after about 2 or 3 months, the fear and the panic will start to abate, which is kind of what we're just about starting to see now. The prices, they may drop a little bit further. But this is really the worst possible time to be selling. And it's the most common time, believe it or not. Everybody does it. But right at the absolute bottom, in order to stop this bleeding, this hemorrhaging, people are calling up at the moment saying, I need to sell, I need to sell, the gold trade's over. And they're missing the point. Because if they do, it creates a massive liquidity event. Then the alligator, the smart money with their snapping jaws, they come in, buy up all those cheap assets in one swift, aggressive move. Then they get a second bite of the cherry for the next run that we're going to see. They're playing a completely different game. They've just got a better poker face, Godfrey. Um,
Absolutely.
but yes, we are all human. We're hardwired to always do the wrong thing when it comes to money because people don't have the patience. So look, the institutions are buying. Retail's too scared to get back in at the moment because they think it's going to carry on falling. But in the next rally, when we snap back, they're going to miss out. The volume of institutional money that we're seeing coming in, pouring into these dips, is absolutely huge at the moment. Retail gets in too late. Again, in 2 months' time, when 3 months' time, let's say the gold price has gone up 20% again, that's when they start buying. That's when the institutions will sell, bring the market back down again. They use them as exit liquidity. And people are getting so frustrated. And this is a conversation that I am having every day with people at the moment. But looking at history, prices rise again and they exceed the pre-crisis levels. They will always exceed that pre-crisis high. It's happened after every major oil shock that we have seen in the last 50 years. And all you've got to do as well, Godfrey, is just look at what the banks are predicting now. They've all got their targets about 40% higher than we are at the moment. They're all in the kind of plus $6,000 range. Deutsche Bank, Goldman, JP Morgan, all of them. But I just want to stress the point that it's about learning these rules, not chasing, not panicking, and just holding your nerve. And when people get tired of the gold story, which is what we're seeing now in the news, that is the exact time that you should be considering topping up your holdings or dollar cost averaging and buying even more. Because in 6 months' time, when the gold price continues to go up again, everyone's going to call up and say, oh, you know what, Nick? God, I wish I'd have done it. I knew I should have done it. And they'll be kicking themselves. So look, the structural setup is still there. Nothing's changed whatsoever. You just got to make sure that you're buying at the right time.
We've got to see, have we not also, we need to prepare ourselves for very significant quantitative easing, money printing, call it what you like. There's no way that the United States can come out of this without significant money printing, which is by definition inflationary. And at the same time, I would argue we've got, it looks like in the United Kingdom, for those British subscribers, that we are going to see Starmer probably replaced by somebody, if you believe this, is even more left-wing, who has a program which we haven't found out yet, but I've been digging into it, about his intentions to spend, would you believe, even more on welfare and even higher taxation, so on and so forth. So there's only one he can dig, where he can dig out, and of course he's at Torsten Bell at the Treasury, and the Bank of England is a Fabian, Andrew, whatever his name is, he's a Fabian. All these people are Fabian. They will print money. They will print paper money, big style. And the last thing you want to do is be holding paper money, because you've got to look at a net interest rate. If you're saying, oh, you've got a gilt or a bond which is yielding 4.5 or 5%, what's your net yield with inflation at 3 or 4%? Zero. It's zero. And the thing is, at least JP Morgan and Goldman, they're all being honest. They're saying that we reckon it'll be $5,000 or $6,000 by Christmas. They're not even trying to cheat anyone. They're saying, look. So the key is, I'm keen on this. I'm fully invested personally at the moment. But if I had any spare dough, I'd be filling my boots at these prices. It's a no-brainer. If you can wait, if you can be patient, and that's the key. So hang on in there, and frankly, buy the dips. I know, buy the dips is my view, and I would put my money where my mouth is if I had any money, but I don't have any money at the moment.
Look, yeah, all fiat is going to zero. It's
Yeah.
all just yes, there is going to be more pumped into the system. And you touched upon this earlier at the very beginning, Godfrey. What else is happening in the world that could cause the dollar to weaken from here even further? Well, the Chinese economy is weakening. They're likely to lower their interest rates as a result. And what do the Chinese do when their currency weakens? They buy precious metals in a big way. And China have been buying for the 19th month in a row now, which actually leads me on to the most important point here about this dip, which is the structural buying that we are seeing coming from the central banks. And like you said, they're not even hiding, Godfrey. Goldman's come out and even referred to this as the most aggressive gold buying strategy in modern history. And in a study this month that came out from the World Gold Council, 74% of the world's central banks expect the the US dollar's share of global reserves to fall over the next 5 years. They're all expressly stating it. So these aren't commentators or analysts, it's the reserve managers themselves at the central banks. And they've been buying 1,000 tons of gold a year for 4 years straight, which was double what it was in the previous decade: 2022, 2023, 2024, 2025. This is the highest figure we've seen since the late 1960s. And 89% of those surveyed at the central banks expect this to continue as well. And I think this is critical when you put it into context, as central banks were not pausing even when we were at the higher prices before this dip, Godfrey. And what everyone is missing, and people are not talking about as well, is the central banks are physically relocating it as well. They're changing who holds it geopolitically, which countries they're keeping it in, who is custodying it for them. Again, that activity's doubled just this year. So what is it that they know about the safety of our current financial system that's making them take custody of their metal? Why is that so imperative now? It really starts making you think, doesn't it, when the big boys are doing it? And another really noticeable thing as well that I have to stress about this study, and what's so critical, is the reasons the central banks have given, what they cited for holding the gold. And there are three major answers that were given. The first two were long-term store of value, of course, as well as performance in times of a crisis. But the third point was there is no default risk. And this is the one we've really got to dive into, because in a landscape where the main reserve asset that everyone's flocking into with their pensions that we've just explained, Godfrey, which is debt, US Treasury bonds, which relies on the faith of the sovereign government, that's a really poignant and significant statement, because it subtly but clearly suggests a complete lack of confidence in the US government itself moving forward. Of course, we've just seen the French take delivery of their gold. They sold it over there because, of course, they didn't think the Americans had it, and they had to rebuy it in Europe. But that's another rabbit hole you can go down. But cutting to the chase, this is now the majority view of the central bankers. They've got trillions in reserve assets. They're running the biggest banks in the world. They have the access to the best legal advice, the best economists, the top advisors. And they're saying the system is built on a house of cards, and the ownership of the physical is definitely worth the cost. I cannot think of a clearer signal, and a clear. It's just so bullish for gold. It really is. You'd never get them coming out and stating this 10 years ago. So everyone in the audience has basically just got to ask themselves, what form are you actually holding your gold in? Because it's no good holding it in paper when the real players are actually buying physical and citing counterparty and default risk.
Let me just add there too, because that's very sound. We are living certainly in Britain at the moment. Most subscribers watching this will be British citizens. We've got to bear in mind that it doesn't matter. Let's suggest that Burnham comes in. It's going to be more of the same. If he comes in, it's the same government. It's the same Fabian government. And if they can see it, they will steal it. It's a way of getting your money off the table. As I've said a lot of time, it's not an investment. We're not saying it's an investment. Gold is a reserve of wealth, and you can consolidate your wealth. It's not an investment. So what you need to bear in mind is it's a way of getting it off the table. If you hold it in paper, it can be seen, it can be taxed, and it will be. We're all seeing this as inheritance tax. They've already said there's a wealth tax in this country coming down the road in 2008. And it's
Hmm.
talking about your semi-detached house in Ealing or wherever you live. You
Hmm.
know, this is which will be, you know, let's say it's 500 grand or something or whatever it is. This has they will come along and it will start small. They'll say it's 1% a year on that, and they will assess your assets. They
Hmm.
cannot assess your assets if it's gold in specie in Switzerland and there's no capital gains tax because it's coin of the realm if it's coinage, which it would be. So you've got to bear these in mind, the long-term view. 2008, it'll be here before you know it. And it doesn't matter whether it's ISAs, whether it's your pension, whether it's your
Hmm.
house, whether it's your life savings, or maybe it's a stock portfolio or bond portfolio, they will steal it. We live in a kleptocracy, and we
Hmm.
must understand that. If you don't understand that, they'll take it from you.
Yep, you have to understand about custody, and that's whether you're actually getting it in your grubby mitts, or you're keeping it in a secure vault. But holding any paper promise, any ETF at the moment, it's financial suicide because when the markets crash, well, they'll just cash everyone out with, well, it won't be worth the paper it's written on, Godfrey. It won't be.
Indeed.
You have to take autonomy back over your finances and become your own bank. Because what happens if they try and implement a wealth tax, for example? Well, they'll automatically go into your bank and suck it out. Doesn't matter whether it's an ISA, current account, whatever it is, because everyone's going to have their national insurance number connected to their bank accounts. It's all part of this digital cage and this matrix that's coming in, trying to entrap everyone so they can automatically deduct these type of wealth taxes from people. So while the life raft and the opportunity is still there, buy it because the central banks are certainly doing so. All the smart money is. It's just the retail investor that's being fooled into thinking that this trade is over. They're trying to get them to sell. Please don't, because the professionals do not care about tomorrow's price. They realize the value of everything and the price of nothing. And that's what's quite difficult about getting some people to view precious metals as. It's looking at things with a completely different mindset and realizing the value of real money in your hands rather than where the paper price of it is on a particular day. Because the experts, they don't care. They're still hoovering it up like it's going out of fashion.
Do we and of course I've got a lot of new subscribers at the moment, so you'll find on my website a direct link to Nick Warden or one of his colleagues there. I know them all, so if you want to get in touch there, you can look at my website. And Nick, do you want to just tell us what how they'll get hold of you for people who want to get hold of you to talk to you?
Absolutely. So, look, Godfrey, if anyone in the audience wants to understand about custody and safety, where their metals are, just general guidance on the market itself, please give us a call. We'll have a no obligation call with you, whether it's 10 minutes or it's 3 hours. We can take you through your options, discuss precious metals with you. If you want to go ahead, you can. Of course, everyone in your audience, Godfrey, gets preferential rates, of course, on storage and everything else as an incentive to look after your audience. But please, 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 while the opportunity is here and it is dipped so much, it's such a fortuitous time to be getting into the market rather than in 6 months when it starts rising again. So ask for me, ask for Daniel, any one of the team here will take care of you. But yeah, feel free to give us a call. You can see the link there in the comments.
And on my website, you'll find past interviews I've had with Nick and other international gurus, of course, and
Mm.
gold. Not dealers necessarily, but strategists like myself. And if you trawl back a little bit on my website, they're all there. And I haven't taken anything down. Nothing's ever been taken down. And you might look a couple of years ago and see we were saying much the same thing in much the same way. And most of the contacts we get now, unless you've been caught out just in the very last 6 or 7 months, by this temporary blip. A lot of people are saying, thank you so much. I'm really pleased. So, this is how things are, but it's a strategic holding. So there we are, folks. Look, that's a wrap, I think. And get in touch with Nick if you want to. Get in touch with me if you want to. I'm not a dealer, but if you want to ask anything, or get onto my website and just get yourself more knowledgeable. Do some homework. It's worth doing some homework, because then whatever you do, you'll be more comfortable with. Don't do it on the fly. You'll drill down, and you'll be much happier. And I think Nick will agree that if you're going to if you're new to the gold market, if you're going to buy some gold in specie, make sure that it's wrapped up, that you can afford to leave it. You've got to leave it. It's like stocks. I used to say things when in equities are the same. If you can't put your money away into equities or bonds or whatever it is, but for less than 7 years, don't do it. It's a strategic holding for you and your family. So I do feel very strongly about it. So anyway, there we are, everybody. I hope you found it fruitful, and I'll look forward to coming on again, and perhaps Nick will come back on again when things change, if things change particularly, and we've got information for you. So thank you again, Nick, for coming on.
Absolutely, always a pleasure, Godfrey. Take care.
As most of you know, my work is very heavily independently research based, and I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So surprise, won't cost you anything. Thank you very much.